Joining me to discuss, Chris Horvers is senior analyst at JPMorgan. It's good to see you, Chris. Let's just start with Best Buy. What did they say?
Nice to see you too, Kelly. Well, Best Buy is suffering from what a lot of my coverage is suffering from. They were COVID winners. They took share of wallet during COVID. You went home, you worked from home, you learned from home. People got checks, so they were buying computers, they were buying iPhones to your last piece, they were buying televisions. These products last a long time, and now we're seeing the other side of that. As we lap through stimulus, people are starting to go back to work at an increasing rate. People are starting to go outside of their home. They're starting to travel and go on vacations. They're just not focused on spending on that home, and that computer is still in great shape that you bought 1 or 2 years ago. So the issue is that we have to go through a period of time here and let that replacement cycle normalize till you might go out and buy your next one. But on top of that, there's more pressure on the consumer than there ever has been. So at the margin, that risk could last even longer.
Yeah, no, I mean, we set foot in a Best Buy for the first time in a decade to buy. It was, webcams with that were higher def and podcasting equipment and all the stuff everyone was doing. And now you're set for a while. So they're the exception, you think, to what was more broadly a little bit more upbeat tone. Who in particular stood out to you?
Well, so yeah, we have one reopening stock in my coverage. That's Ulta Beauty. Obviously, they benefit from people going back to work, putting makeup and cosmetics on, going to events like parties, graduations, family get-togethers, and travel. So they're very excited. There's a lot of innovation in the category this year. There's a lot of newness. That's great for Ulta. I think that the middle three companies, call that Home Depot, Lowe's, and Target, there's a question going forward, especially with the housing side. Rates have moved up a lot. Housing obviously boomed during COVID. Spending on the home boomed during COVID. So you might not need that new appliance. You might not need that new grill. You might not need that new dishwasher. So that's something that'll play out over the year. And given the lagged correlation to home improvement demand, things probably get worse in the back half of the year now that mortgage rates are up almost 200 basis points and actually back to pre-COVID 2018 levels.
Right, and you cite Ulta, just to go back to that one for a moment, as one example of a company pinched by fuel surcharges. So again, a lot of people that might not be first to spring to mind. We know housing's been a struggle. Advance Auto, that remained one of your favorite stocks. What was the tenor there?
Yeah, so the auto parts broadly, it's an interesting space because that lower-end consumer is a DIY consumer. They change their own oil. They work on their own car because they have time and they can't afford to get it done at the shop. So there was certainly a benefit there. But the rest of their business overall is really driven by miles driven. So you and I going back to the office, that gets cars on the road. That is pro-cyclical for their business. So despite higher gas prices, miles driven should continue to grow. And at the same time, because there's a supply chain issue around new cars and producing new cars, people are investing more money in keeping their existing car going, and that is great for the auto parts business, including AutoZone, Advance Auto, and O'Reilly Auto Parts.
That's a really interesting point because we know auto demand in general has been, we could call it a headwind as we go post-pandemic, but you don't necessarily see it going the way of Best Buy. Let me just end with Target, one of the most widely owned retail stocks. Where do you see it going from here?
We love Target. Target is one of the biggest share gainers in our coverage. If you think about COVID winners that have a better competitive set going forward, there are a lot of closures on the mall, a lot of department stores closed. That's great for Target. 55% of their business in general merchandise, so that's apparel, that's home furnishings, that's electronics. They're gaining share. And the other 45% is consumables. So we like it better, certainly, than Walmart. It's a higher income consumer, so you have less risk of trade down, private label, and negative general merchandise mix. And frankly, if you went back to the fourth quarter, they have the best traffic trends in all of large cap retail, even better than Mighty Costco.
Mighty Costco.
That's right.
We talk about them a lot here. Chris, it's great to have you. Thanks. And again, maybe a little bit more upbeat message even than what we're hearing